Welcome back to the next part. So again, we're going to be talking about theta. So in this example, we've been talking about Apple trading at 121. We're looking at the 121 call option. So again, calls, it means going up. And again, the strike is the current price that you're willing to pay for Apple if you wanted to exercise. So again, exercise just means that you're willing to change your contract into 100 shares, but you don't have to. You could sell it at any time. So now we're going to be talking about theta. So theta is this third column right here. So theta is negative 0.15 for the 121. You could kind of see it's roughly the same for all of them. And now in the example, hopefully it'll make a little bit more sense. So in this example, again, we're looking at Apple March 19th, 121 call. You're paying, again, $2.14. You multiply it by 100, you're going to get 200. You're paying $214. So again, you think of this as your non-refundable deposit, but you could sell it at any time if it does go up. So theta, what theta means is how much your contract is going to lose every night until expiration. So you're going to lose roughly 15 cents or $15 every night until March 19th if Apple stays at $121. So that's the main thing you have to focus on. So if Apple's constantly trading around $121, you're going to lose about $15 every night. So let's say the next night you buy Apple and Apple opens up again at $121. It's the exact same price. Now you're actually going to lose $15 on your contract, even if Apple doesn't do anything. So what that means is your contract will now be worth $199 instead of $214, which you originally paid. And again, it's just $214 minus the $15. And that's how you get $199.